agency in downtown Dayton is where my office is, and I'm also a real estate investor. I bought my first duplex in August of 2017. That was like a cash deal. My wife and I moved up from North Carolina in April of 2017, and that was specifically to escape the rat race that everybody was talking about. We had a baby. It was really important for us that she'd be a stay-at-home mom, but I was in law enforcement, and I just couldn't swing it. So due to the cost of living and just reworking everything that we did, we took the equity out of the house that we had, bought our duplex. The snowball started. We're now up to about 40 properties once we close everything that we have under contract. And I eat, sleep, and breathe this stuff. I swear by real estate. I have a phenomenal day job where all I do is talk to investors all day long. My favorite kind of clients are the ones that come to me, and I am able to just teach everything that I know about real estate, make sure that they get an awesome insurance policy, so that regardless of what happens, that generational wealth that we're all trying to build, the cash flow is protected. So despite this hurricane, any sort of disasters that could possibly happen, your properties are covered, your cash flow is not interrupted, and you're able to pass on this legacy that you're creating to everybody else. So I'm attempting to educate and create as much content as possible. So all of these books is for sale on Amazon. I'm actually really proud of it. It's currently the #1 new release in business insurance. That's like small pond, big fish stuff, but nonetheless, I'm really excited about it. So this is a lot of good information. This is pretty much just like the most frequently asked questions that I get from my clients, like the difference between actual cash value versus replacement cost, what basic, broad, special form means, and a few really fun words that are specific to insurance, like dwelling fire and peril. I should explain what those are. So now that you know those two words, you should use them pretty regularly. Dwelling fire is just a non-owner occupied house, and peril is any sort of like cause of loss. So a tornado is a peril, a fire is a peril, theft is a peril. I guess I won't geek out too much about all this stuff. But truly, I say it several times in the book, if you ever just want to talk about real estate, give me a call. That makes my day. I, again, eat, sleep, and breathe this stuff.
Is your information in the book?
It is. Several times. I may have gotten a little carried away with it.
I have a question for you.
Yes, ma'am.
So, a question that I was actually asking Monday. I have not that I have many rental properties, but we have our auto, our homeowners, and then our rental properties all in one, if not the same policy, but with the same insurance company. And I'm wondering if that's a good idea or a bad idea. We do it so we can get reduced costs, the grouping. But it also feels, I don't know, is that a good idea?
To have them all with the same insurance company?
Yeah. It feels a little vulnerable. If I make a claim with this insurance company on a rental property and then my house catches on fire, is that that experience that they're talking about?
So, I actually got into a good conversation earlier about clue reports. So all insurance companies share information. So if, let's just use the big one. So if you had your house with Nationwide and then, one of your rentals with USAA, the USAA house burns down, and then you also have a claim with, did I say Nationwide? Yeah, so they would know about it. Once the renewal runs, it will pull all of the recent information, and the price may change due to that. The experience or the loss experience is what they like to call it. I don't think it makes you any more vulnerable. All the main insurance companies are all on like what they call the admitted market. So those are all backed by the state guarantee funds. So if Nationwide or USAA were to become insolvent and a bunch of claims were to be out there, then if they weren't able to make good on those, then the state would actually come in and pay for that loss that Nationwide or USAA wasn't actually able to pay out. I would say for like the discount, that kind of teeters off, especially for real estate investors once you get past a certain threshold of policies, there's just very little discount to give. So a lot of investors, once you probably reach like 3 or 4 properties, it's really not beneficial to necessarily have all of your like personal and businesses policies in the same spot. If they're all in your personal name, then having them all with the same company makes it a whole lot easier to have like an umbrella policy over it. But I wouldn't have any concern about, I don't want to go on too many tangents. Did I answer that question?
I think so.
Okay, that's how I felt. There's so much stuff that I want to say.
Well, this was, yeah. I mean, you brought up the other aspect of it is, I was asking in a sense when I was saying vulnerable, like making too many claims, but since the state of Ohio is sharing my information with the next insurance company, I guess it doesn't really matter.
I don't think that report is state mandated. LexisNexis is the one that keeps that giant database in order. But generally the rule of thumb is if you have 2 claims in 3 years or 3 in 5 years, if they're all with the same insurance company, you might get a letter that says, hey, we're going to non-renew your policy at the end of the year. But that's generally not too hard to just go to another company. You will get a surcharge, but I don't know. I wouldn't worry about it.
Yeah.
My personal stuff is, well, my stuff is all over the place, but I got a lot of different companies, but I wouldn't have any apprehension to having them all in the same spot. But at a certain point, like your Nationwide, the USAAs, the majority of them, Safeco, they all have their own levels of how many properties that you can have before they're just not interested anymore.
Okay.
Yes, sir.
Sir, you brought up USA, which is interesting. They've been losing money in property and casualty for years. And last year they sucked a lot of it out of their reserve fund. Do you think they'll survive?
USAA?
Yes. They're big and they put out a lot of smoke, but there are not a lot of people who can lose money more than 4 or 5 years in a row.
It's a trend that I've seen. A lot of the larger property and casualty people are really scared about things like, Amazon, Uber, a bunch of like internet-based stuff. A lot of people are in fear that property and casualty insurance is going to be like, it's a long word that starts with C. I might mess it up because I'm in front of a bunch of people. Commoditized. Yeah, there we go. Those 2 words that you guys said, the one word. Yep. So USAA has actually gotten really more conservative, probably because of the bleeding, but I don't know. I mean, you know what? A lot of times when I tell people I'm in insurance, they kind of get a smug look on their face and say, yeah, like you go to the big city, like all of the tallest buildings are insurance. So I don't know. I don't foresee anything bad happening, but I guess the company could become insolvent, but they've got tons of money. I don't think losing will be a problem.
Could I ask you a question? Are you insuring your properties for replacement or for what you paid for?
People are paying for them. Well, you know what, honestly, I've been really careless with it. I need to check, because I have been really careless with it.
That's one of the reasons I wrote this book. As I became an investor and I started having conversations with other investors, I have so many mentors here in the Dayton area that they're some of the smartest people that I know. Janice's son Darren being one of them. And when it comes to insurance, there's just a lot of question marks and just kind of willy-nilly stuff happening. So, I mean, replacement cost versus actual cash value. So replacement cost, the insurance company uses their own little calculators, which puts in the square footage, all the building materials, like it was built before I don't know the exact year, maybe 40s when plaster was still a thing. Like you can switch it on the calculator from like plaster to drywall, and that'll take like $30,000 off the overall replacement cost value of that. So there is some flexibility in it. And then actual cash value is a lot more flexible, where if you paid $40,000 for a property, you can say, I just want it insured for $60,000. And actual cash value is the same thing as replacement cost, except it also factors in depreciation. So actual cash value is replacement cost minus depreciation equals actual cash value. So if your roof, since the tornado just happened, I've been filing a lot of roof claims. So one of the roofs was only 3 years old. The general rule of thumb with actual cash value is the depreciation is 1% per year up to 50%. So that particular roof was 3 years old. So the insurance company came in and gave them the replacement cost to get a new roof minus 4.5%. They used 1.5% for 3 years. So they reduced the replacement cost by 4.5%, and that is what